On the Wrestling News Network, here is news report number 31. Today I'll be talking about the Robinhood stock sale controversy. Robinhood, it's a trading app, way to make money. It's used to, it's an app to revolutionize trading and an app to make smart decisions. Robinhood Markets Inc., bid to revolutionize IPOs, has created losses for investors instead after one of the year's most highly anticipated listing fell flat. In a regulatory filing in early July, the trading platform co-founders said they would open their initial public offering to customers on equal terms with institutional investors. They said that they recognized it may be the first IPO many would participate in and pledged to, quote, never sacrifice the safety of our customers' money. It now appears Robinhood's commitment to democratizing the IPO process played a role in offering big initial stumble Thursday. An innovative auction system sowed some confusion among investors, many already suspicious of the valuation of a business that has drawn scrutiny from regulators and criticism from customers, people involved in the process said. The stock, initially priced at $38, the bottom of the target range, sits below that. It is a disappointing result at a time when the IPOs are booming and investors' appetite for new issues is robust. Robinhood proudly tore up the traditional IPO playbook. It insisted a large chunk of its stock it end up at in the end it end up at 25% go to its individual investor customers compared with the normal retail allocation of well under 10%. It said employees could sell a portion of their stock right away instead of being locked up for 6 months. The hybrid auction has worked in other IPOs in the past year. In typical listings, underwriters give their investors' clients updates throughout the roadshow, the 7 to 10 day period in which company pitches its stock. These updates typically include guidance on how much demand bankers are seeing for the shares and the rough price they are ultimately expect to set. In the case the company and lead underwriters Goldman Sachs Group Inc., JP Morgan Chase and Co. gave few such updates. People familiar with the matter said. When some large investors called the other underwriters on the deal, some of the bankers pleaded ignorance. The opaqueness of the process sowed suspicion among some investors who assumed the deal was going poorly and adjusted their orders accordingly, investors and bankers said. Many had already expressed concern about how much of Robinhood's revenue comes from a controversial practice called payment for order flow, which the Securities and Exchange Commission is reviewing. People who attended the roadshow said others questioned what they saw as a high valuation the eight-year-old company was seeking, in excess of $30 billion. Another concern was the Robinhood's controversial decision earlier this year to stop users from buying meme stocks like GameStop Corp would prompt some to eschew the offering. An unusually large percentage of shares were set to be allocated to hedge funds, which are most likely to flip IPO stocks on the first day of trading, according to the people close to the deal, to bring in more of the biggest institutional funds who are viewed as buy and hold investors. Robinhood chose $38 a share instead of the higher price some funds were willing to pay. Companies and Goldman felt comfortable that the lower price was conservative enough that the shares would rise on their first day of trading, especially given the buzz around Robinhood in the lead up to listing, according to people close to the deal. Instead, the stock opened up $38 a share, unusual at a time with the big initial pops for hot IPOs are more than the norm. It rose higher briefly, touching $40 before dropping through the IPO price. It closed down at 8.4% Thursday before recovering slightly Friday. So, this concludes the finances, suspicions, the IPOs, exactly what's happening with Robinhood's finance. It's news report number 31. I'll let you know when the next one comes out, 32. Thank you for watching.